This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. The particulars contained herewithin were obtained from sources we believe to be reliable but are not guaranteed by us and may be incomplete. The opinions expressed are based upon our analysis and interpretation of these particulars and are not to be construed as solicitation or offer to buy or sell the securities mentioned herein. The opinions expressed do not necessarily reflect those of National Bank Financial.
A pleasure to be on the podcast with you today.
Absolutely.
For sure.
Yeah, it's the Gordon boys for the first time
For the first time. Feels good.
There we go.
All right.
Well, we have an interesting topic today that's really prevalent in the market, and that's the rise of passive investment vehicles.
Mm-hmm.
And as we know, over the last 30 years, it has revolutionized the way investors invest and get exposure to global equity markets.
Absolutely.
And as we'll touch on in a moment here, we've seen a massive influx into these passive investment vehicles at the expense of actively managed funds.
Yeah.
And it's a really big topic to cover, so we're just going to touch on it lightly here.
Massive.
And
just scratch the surface.
We'll have different segments on this to go through some deep dive discussions.
Yeah, no, I think the way that we're going to have to break this down, like you said, is the ETF landscape is so big, so diverse.
Yeah.
There's so many different moving aspects to it where I don't think a majority of people actually understand the depth of this space.
Oh, hey, I don't think the average investor really understands the magnitude
has one clue. Right?
And
what is out there.
I think it's a good place to start and talk about the landscape as a whole, both in Canada and the US. So if we look at the slide behind me, sorry I'm in the way, but we'll make sure the viewers at home can see it on their screens. In Canada, roughly there's $420 billion in ETFs across around 1,100 funds. And if you look back all the way to 2018, there was roughly $156 billion. So relatively over a short period of time, we've seen robust growth within the ETF market.
Yeah.
And then if we look to the neighbors in the US, it's the same picture.
Mm-hmm.
Same story.
Mm-hmm.
53% of assets under management in the US are now passive.
Yep.
It's overtaken active funds.
Mm-hmm. Mm-hmm.
And obviously this has implications for markets and investors. And
I think the challenge is not too many people are aware of the implications.
For sure. So I think that's a good place to start. So what do you guys make of this current trend that we've seen transpire over the last 5 years?
Well, I mean, if you go to your next slide, I mean, worldwide, ETFs have had explosive growth. And if you go back to 2003, you're looking at $204 billion. The end of last year, we're at $11 trillion. $204 billion to $11 trillion. And now we have over 10,000 different ETFs around the world. So it's the flavor of the month. Think about it.
Yeah,
I mean, we've got single leverage, double leverage, triple leverage, anything you want. You know, we just launched the Bitcoin.
You don't even have single stock ETFs now that are leveraged. It's crazy.
Absolutely mind-boggling.
Yeah.
So you have to say, well, why have we seen this explosive growth in ETFs, and why has it gone from active management to passive management? Well, pretty simple answer. There's no alpha. Mm-hmm. There's no rates of returns over and above the market. So if we go back 15 years in the U.S., 93% of all managers over a 15-year period failed to match the benchmark.
And it's a similar story in Canada.
It's the exact same story.
You look at a 1-year picture, 70% of managers failed to beat the benchmark over a 1-year window. And you extend that to 10 years, and it's over 90%.
Well, it's the same thing in the U.S. You know, you back up, okay, well, 93% didn't perform over 15 years. Well, cut it back to 10. Okay, well, 90% didn't outperform. So you've seen this huge move where managers haven't been able to beat the index. And the reality is that the way that managers are doing their portfolio construction, they're basically being closet indexers.
They are the index.
They are
right?
the index.
So how are you, and this is a completely separate topic that I think is going to be needed for next discussion.
Yes.
But how are you expected to beat the index if you hold basically everything in proportion to the index? You have over 100 holdings in your individual mutual fund for that matter. Your R squared or correlation component is basically 90%. So if it looks like a duck, walks like a duck, it probably is a duck. And when you charge obviously an embedded management fee of sometimes 2%, even if you're owning F-class, 60 basis points, if you are the index and your holdings are the index, of course you're going to underperform.
Absolutely.
Of course you're going to underperform. And we'll dive more into that
but that's, you know.
And is part of the problem the institutions don't hold their managers accountable for delivering alpha?
Well, it's the mindset. It's the fact that if we take a look at what we do at Veris and we look at Poland Capital, we believe in concentrated portfolios.
Creates wealth,
22 to 24 names, but most fund managers out there today, as we said, I mean, they basically look exactly like the index. So why is that? Well, they're afraid to take the risk. We know our Poland Capital has a 15% weighting in Amazon.
Yep.
How many managers are there in the U.S. willing to take a 15% weighting in Amazon? Not too many. Mm-mm. And the reason for that is managers are afraid to get it wrong. So they're not willing to have the conviction to say, to beat the benchmark, I need to do X. Because if they're wrong, they're concerned about redemptions. They're concerned about their jobs, and it's called career risk.
Yeah. And I think another kind of side point on that, even if the manager does have conviction, and us at Veris want to allow a manager to deploy their conviction in whatever way that they see fit. If they're an expert and they have their niche, they should be able to deploy their strategy. But the problem becomes, obviously, if we take out the independents for that matter, and we actually look at the major mutual funds from, I would say, the top banks, is sometimes it actually doesn't even come down to the manager's conviction. It just becomes down to, and I don't want to get in trouble saying this, but it's the legal requirements that have been set by those larger institutions.
Exactly. It's the investment policy statements that were written by the lawyers, not by the managers, that basically handcuff them to be closet indexers. Okay.
So sometimes there's no fault to their own.
Yeah. It's like I have to be 2 to 3% over and above technology.
Yeah.
You know,
can't have a weight over 10%.
So
needs to be in X amount of sectors.
What that is, and what we've commented over the years, is that the whole mutual fund industry is all about relativity. It's not about absolute returns. And as we say, you can't eat relativity. So it really boils down to that investment policy statement, and
everybody's handcuffed.
Everybody's handcuffed.
Yeah. And that's why you've seen such terrible, I think, performance numbers across the board.
Brutal.
And hence why
we're at 11 trillion.
Hence why everybody's given up on the active management.
If you take a look at the 11 trillion and the 10,000 different ETFs, the 4 largest ETFs are the S&P 500.
Yeah, of course. Yeah, so obviously big reason.
For sure.
Big reason why we're starting to see,
and then
where we've seen
the next graph clearly indicates that. You can see the amount of equity funds, which are on the bottom in the gray, and how they have really been selling off at an alarming rate. And where's this money going? It's going into passive ETFs. And we at Verus have concerns about the concentration and all of that, which is going to take several discussions.
Of course, that's why this is a little bit of a series.
We're
we're just trying to scratch the surface here. God forbid we could be in this room for a week and not even get through half of it.
Order out food.
Yeah, I know.
So, Cody, what are some of the implications of the amount of fund flows that we're seeing transpire? Are they manipulating markets in any way?
Yeah, so I think that there's a lot of risks out there, specifically kind of in relation to everybody mainly just being basically flow driven at this point, right? Everybody becomes a price taker. If you've given up on active management, you end up just taking the price for whatever the underlying basket of securities, regardless of fundamentals, right? So it becomes a game of fund flows. And so when you essentially purchase an ETF basket, you go out to essentially the market maker, they create that basket of securities and unitize it for you, and you just take whatever is in the index. So proportionally, everything's going to rise. And so what we've seen over the last little bit here is momentum-based strategies have actually tended to outperform. And we see from a manager's perspective, people are obviously looking at that. It's not a game, like I said, of fundamentals anymore. It's mainly just a game of flow. What is hot, what is trending, tends to now outperform, right? And especially, I would say, over the last 10 years, where you've had not many, I would say, large corrections for that matter.
Yeah,
obviously the
COVID correction was a bump in the road.
It was a bump.
Down
It was a bump. It was a bump in the road.
We're out of it in less than a year,
right?
But what that leads to is like amplified volatility and potential bubbles in some areas.
Yeah. So you get when you become obviously a price taker, you're not looking at fundamentals, and everything just becomes what we call, like I said, flow based but factor based investing. Right? Everything. A lot of managers are just looking at factors. Quality, size, momentum is obviously the main three, but that really kicks in to the volatility segment of an overall index, right? You look no further. Fund flows, and especially a lot of the algorithms that have been designed around portfolios today, during COVID, thank God those circuit breakers were in place.
Yeah.
Because if not...
Absolutely.
And they learned their lesson in 1987, obviously, when the index corrected basically 20% in one day. Once fund flows start going the opposite way and sediment starts to drop simultaneously, you've seen the result in COVID of what happened.
Yeah.
I don't know I forget the exact number, but I remember sitting at my desk basically in March. I was coming into your office saying, what the hell is going on here? But we hit level 1 circuit breakers, trading pauses for 15 minutes. And it's because people are exiting. Flow is exiting the market at an alarming rate to where nobody can catch up.
And that's some of the dangers going forward with this huge concentration. If you look at the MSCI World Index, which was created 38 years ago, which makes up 23 developed countries in the world with large to mid-cap companies. Today, it is dominated by the U.S. 70% of the MSCI World Index is in the U.S. And when you have those flows into, like, let's say the Magnificent Seven, it's astronomical, and a lot of this could be, we don't know, we're not smart enough, this thing could keep going. What concerns us at Verus is, how are these passive investors that really haven't looked at valuing the fundamentals, how are they going to react if we get into a prolonged bear market, which nobody's really seen since 2008, 2009, or going all the way back to 2000.
Yeah.
I think that's a concern.
Yeah, a huge concern for that matter, right? And we've seen kind of what transpires on the downside quite in a very short period of time, obviously with COVID, but the bounce off the bottom was unprecedented.
For sure.
Right?
Yeah.
Quick snapback. Nobody's ever seen that.
Never happened in history before.
People tend to forget and a lot of the newer investors weren't around for 08, 09.
No.
It took you 6 years to get back to parity on the S&P 500.
That's a long time.
This is not your quick snapback.
And will the new investor, will they have the patience?
Will they have the patience, and will fund flows return dramatically after an obliteration like that?
Yeah.
Right? So there's some risks, and I think I want to dive into in a separate podcast those elements a little bit more from a fund flow standpoint, how indices have been constructed specifically, I would say, to benefit the large players of the ETF landscape. And like I said, we're just scratching the surface here because there's a lot of things that most people don't understand when you go to the robo-advisors or your advisor, for that matter, is just utilizing ETFs.
You mentioned diversification, Ken, and the problem with that is investors think, okay, I can buy the S&P 500 and I'm diversified across 500 companies. Yes, that's true, but the problem is that
the weightings,
the indexes have become so concentrated. Look at the S&P 500, right? The Magnificent Seven
make up over 30% of the S&P 500.
The graph behind me says it all.
Yeah, exactly.
Yeah. And so the concentration, Ken already alluded to it, right? 70% of the MSCI All World Cap Index is the United States. Then you take a look at that 70% sliver, which is the majority of it, then the mega cap sevens drive the entirety of that 7%. So is your portfolio really diversified? Not really.
NVIDIA is the same weight as Canada.
Yeah. So how do you, and that's the other kind of factor that we'll touch on at length in another separate podcast, which is how is anybody controlling risk, right? So
they're not.
Yes, there are, like Ken said, that ETFs are a flavor of the month. You can select sector, you can select style, you can select different factors. There's now active ETFs.
Yeah.
Whole bunch. Like whatever you want, you can essentially get.
Yeah.
But the majority of ETFs in terms of actual AUM is mainly in the passive indices, right?
Yeah.
And so that becomes a very big risk where if you're a price taker, you're not looking at fundamentals, your portfolio is overweighted to specific names, and God forbid, if the high expectations that have been set on the majority of these magnificent seven companies to deliver essentially the results from their AI businesses falters in any way whatsoever.
Well, just look at Google.
Quick little blip, 4.25% in one day.
And if
that was just this week.
Earnings didn't come out,
it would have been.
And yes, $24 billion of earnings in one quarter, which is absolutely mind-boggling. But it's priced in some respects to perfection. Yeah. And if there's any let's hypothetically, the street was looking for $21.9 billion. They came in at $24 billion. Well, what happens next quarter? If they don't hit that target, it's going to affect the whole market.
100%.
For sure.
Right? So it's just, you have no ability to control your exposure to individual names or sectors for that matter if you're just buying the full lot. And a lot of advisors will go out there and try and time sectors and time all of those macroeconomic calls using ETF vehicles that are cheap, inform their clients that we're going to X sector versus Y sector, just to seem like they have some sort of active hand in the strategy while charging basically nothing for the, obviously,
well, it's
the ETF.
It's easy in this last go round, 11 trillion. all you're basically saying is I've given up on human intellect.
Sure.
Yeah. And I think we're actually going to be entering a turning point here where
it reverts.
Obviously the 10-year numbers, 90% of active managers out underperforming the index. You got to understand the U.S. index or the S&P 500 during what was the easy money phase was obviously the best place to put it.
Absolutely.
We are not at a place anymore where there's easy money. And the longer that we stay restrictive, the more that the market contains the concentration that it does, the higher the risks, and I think the bigger implications there are going to be on the downside. And this is just my opinion, but the next 10 years, I believe, are going to be the biggest years for active management to shine, where capital is now not free, and you have to diligently allocate that capital correctly.
It's going to come full circle.
And I could be wrong. I don't have a crystal ball, but you know what? We'll see how it all pans out, because things are getting, I think, in my opinion, a little bit hairy.
You take a look after 2008, 2009. What was the norm for most advisors across Canada? If you first don't succeed, set the blame. So what did they do? They fired the professional portfolio managers, became portfolio managers themselves, used a model portfolio of stocks, added it with ETFs, and now how are they going to fire themselves when this thing comes full circle? That's going to be an interesting dynamic for the industry as a whole.
No doubt. And especially if those model portfolios are set by the firm. Right.
Oh yeah.
So,
I think there's going to be.
It's going to be. I'm to be honest with you, I'm kind of actually quite excited.
I think active management is going to shine in the next 5 to 10 years, because with all these fund flows, you have a lot of companies trading at unreasonable valuations due to the fund flows. Oh, right, and that's a perfect market for active managers to thrive.
Totally. You get mispriced securities when you have. When you have money thrown at obviously a vehicle, you just take a look at the bid ask spread. It's obviously going to bid it up. Some of those companies don't deserve their share price to be
because they move in a synchronized way.
We're not suggesting that Microsoft and Apple aren't great companies, because they are. But when they have $3 trillion of market cap and there's 195 countries in the world today, and if Apple was a country, it would rank in the 7th largest country in the world based on their $3 trillion valuation. So same with Microsoft.
It's bigger than all of Asia.
And I know we've been touching mainly on the equity front too, right? But it also comes down to a fixed income front.
For sure.
And I don't think anybody really kind of realized actually the devastation that really transpired if you were just a completely passive either American or Canadian fixed income investor in 2022. If you just sat there, and equities is a full nother realm, obviously from a fundamental standpoint. But I've spoke at length about this in our previous podcast. But if you become a price taker for fixed income, and all your advisor or yourself thinks about is fixed income is my diversification from my equities, right? When equities go down, well, guess what? My fixed income's going to hold up. Well, you know what? That's actually really not the case. In any shape or form. Fixed income was the most dangerous asset class heading into 2022. The 10-year Bank of Canada note in December of 2021 was 63 basis points. Very apparent the Bank of Canada was not going negative. So where did you think yields were headed?
Only up.
Only up. And most people don't understand. Oh, well, you know what? Even if we did have the recession, my bond portfolio is going to hold in. Nope. Fastest hiking cycle in over a couple decades.
22 years.
Pushed the FTSE Canadian bond universe and also, obviously, the U.S. fixed income benchmark to the largest drop in over 100 years.
Yeah.
So if you didn't manage your duration risk and you just took the passive approach, sorry,
You got
you
burned.
felt the full pain of that. And I've seen a lot of robo advisors' portfolios, their conservative portfolios.
Well,
They didn't manage that risk.
All you really have
They-
to do is answer 12 questions on the questionnaire.
Oh, and you're
then
fine.
You're fine.
You're
It's
fine.
easy. And
That's
then
it.
12 simple questions.
Exactly.
And then it puts
You're automatically
you out
diversified.
A beautiful portfolio of ETFs. And everything will be fine.
It will be fine.
What we're saying
Buy, hold,
is
buy,
maybe
hold,
it's
and
not going to
prosper.
be fine
No.
going forward.
Maybe it's not that easy.
Yeah, and so the fixed income side is a whole
sure.
other aspect. And don't get me wrong, ETFs there are some substantial benefits that we will talk about ETFs, from utilizing them for tax loss harvesting purposes to maintain asset exposure, from a fixed income standpoint to maintain liquidity, to obviously changing your duration and credit risk at certain points in time quite quickly without
Tax loss
the
selling at
underlying.
the end of the year.
Yeah, all of those different things. There are great elements to ETFs, but people need to be aware of the drawbacks and specifically how to utilize them.
And I think that should be the point of discussion on the next series of this podcast.
100%.
Yeah.
100%.
Okay.
Well, that was fun.
All right.
Okay, well, yeah,
Thanks.
we'll have a lot more lined up, but
Absolutely.
just scratching the surface.
Nice to be with my boys.
Yeah. Perfect. It was fun.